Hey everyone, welcome to Do Different Better, where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, Connective Institute, and general partner in the Integrated Capital Fund. Thank you for joining me today. In our last episode, we talked about how the rich and famous use and don't use estate planning, not just for after they're gone, but also how it helped them while they were actually alive. And it can help you too with your money moves. I also talked about the probate process and the power of wills and trusts, and my latest obsession with the gentle art of Swedish death cleaning. But we're going to take a turn today. Today, we're going to be exploring different types of asset classes, which are categories of investment instruments. These are where you can actually invest your money. We're going to discuss the opportunities and the limitations of each access class. We're going to talk about how to access them and the different regulations that govern them. We're also going to talk about the difference between an accredited investor and a non-accredited investor. So let's get started. So in this first segment, we're really going to focus on understanding the difference between an accredited investor and a non-accredited investor. Notice I didn't say unaccredited investor. The proper term is non-accredited investor. This is key in knowing what investment opportunities are even available to you. Investing can be such a powerful way to grow your wealth and achieve financial independence, but it's really important to understand what the different asset classes are and what they can offer to you. But diversifying your portfolio, which just is a big word for saying like making sure that you have different kinds of aspects or instruments in your portfolio that are all performing sort of in some kind of harmony. But diversifying your investments across various asset classes can really help you manage risk, meaning the potential to lose money, and improve your chances for achieving your financial goals, whatever those goals are. Maybe your financial goals are you want to live overseas for 6 months out of the year. Maybe your goals are you want to be a nomad and you want to live in a different town every 3 months. Well, there's some financial aspects to that, and investing can be a powerful way to help you actually achieve that. So, as we're diving into today's topic, it's really often overlooked and not really talked about, but it's really an important pivotal point, and that is knowing the difference between an accredited investor and a non-accredited investor. Knowing where you are can help you open doors to new investment opportunities and help you understand why some investments may not be for you or out of reach for you at this moment in time. That doesn't mean it has to stay that way forever, but it's really all about being informed and making smart decisions. So let's first define what is an accredited investor. According to the United States Securities Exchange Commission, an accredited investor is typically someone who meets one of the following categories, and there are two. The first one is the individual has a net worth of over $1 million, excluding their primary residence, meaning that maybe you have a business, maybe you have other properties, maybe you have an inheritance, maybe you have some other stream of income or in multiple streams of income that have you have a net worth, meaning all of your assets minus all of your obligations, your financial obligations, you are left with $1 million or more. And that does not include where you live. So you may have $1 million home, but if your assets outside of that home minus your liabilities does not equal $1 million, you are not an accredited investor, right? But here's another scenario where you can be considered an accredited investor, and that is that you're an individual with an income exceeding $200,000 or $300,000 with a partner in the past 2 years. That if you are staying at that same income level, you can qualify as an accredited investor. So let me say that one more time. If you earn $200,000 or you and your partner earn $300,000 and you have sustained those wages or that income for the past 2 years, you can be considered an accredited investor. So those are the two scenarios that, under the designation by the SEC, or the Securities Exchange Commission, if you qualify for one of those two categories, you can be considered an accredited investor. But in its simplest terms, an accredited investor are generally people who are called high net worth individuals. You may see the initials HNW, but high net worth individuals who have financial knowledge and capacity to absorb the risk that are associated with different kinds of investments. This status gives them access to investment opportunities that are not available to non-accredited investors, such as private equity, hedge funds, or certain types of real estate investments, or what are called private market investments. They're only available in the private market for certain people. Now, let's define non-accredited investors. Non-accredited investors are individuals who do not meet the criteria that I just mentioned. But most everyday investors fall into this category. Non-accredited investors typically have fewer assets and lower income levels, which means they do not have the experience or the capacity to take on high-risk investments. So, why is this even a thing? Why do we even have this thing called accredited investors and non-accredited investors? Seems very, defining, right? Well, the reason why that we have this thing called accredited and non-accredited investors, Congress passed the Securities Act of 1933, also sometimes called the 33 Act or the Truth in Securities Law. It was set up to protect investors after the stock market crash in 1929. The law prohibits fraud, deceit, misrepresentation in the sale of securities, stocks, or bonds, right? Any kind of security. That means any sort of ownership into a business is called a security. All investments are considered securities. So when you hear the word securities, that typically means it's synonymous with investment. And if it is an investment, then it is governed by the Securities Exchange Commission, or SEC. You might hear those initials a lot, especially if you're watching the news. They'll say, the SEC did this, or the SEC said that. And that's who they're talking about, the Securities Exchange Commission. They write all the rules, like the IRS writes all the tax rules. The SEC writes all the rules related to investments. The act is meant to protect people from getting over their heads in investments that they don't understand. The prevailing thinking is that wealthy people are more savvy than less wealthy people. And I can tell you from personal experience as a consultant in impact investing and social finance, wealthy people are not necessarily smarter than non-wealthy people, right? So I really want you to think about this as an opportunity and not something that's exclusionary, because just because this is what the ruling says does not mean that you can't have access or build a pathway to access being an accredited investor, right? The situation can be temporary. So why do these categories even matter? The main reason is protection, and not just for the investor, actually. Investing always carries some risk. There's an opportunity to lose your money, right? But some investment opportunities are particularly high risk and complex. So the SEC restricts access to these investments to accredited investors to help protect less experienced investors from taking on more risk than they can handle. It's a way to ensure that people investing in these high stakes opportunities are financially sophisticated enough to understand the risk involved and how they might be harmed if the investment doesn't do well, right? Well, there is no test to certify that you are an accredited investor when you are considering an investment that is for accredited investors. Typically, there's a checkbox and a signature that is required on the documents that you're going to sign that have you self-identify as an accredited investor. However, in some instances, you may be asked to provide documentation to the people or the representatives in a investment due diligence process to make sure that you are an accredited investor. Part of this is to protect themselves from liability and legally, because there are situations where it is illegal to present an opportunity that is only available to accredited investors. And we'll do another show on that, getting into deeper of like what are the different types of investments that are only available, and what that checkbox process means and what that due diligence. But we did talk a little bit about due diligence in a previous show. So I encourage you to check out that episode, because in the due diligence process is typically when somebody will say to you that they are looking for, they want to ensure that you're an accredited investor. Here's another fun fact. Only about 10% of US households qualify as accredited investor. That means that the vast majority of people are non-accredited investors and might not have access to certain kinds of high risk, high reward investment opportunities. But don't worry if you're not an accredited investor. There are plenty of investment opportunities that can make you have a very strong and diversified portfolio, from stocks and bonds to mutual funds and EFTs, and I'll talk about what those are. There are many ways for you to invest wisely and grow your wealth and become an accredited investor. So here's my call to action for you. Take a moment to assess your investor status. Are you accredited or non-accredited? Knowing where you stand, you understand what investment opportunities are available to you and how you can start building a diversified investment portfolio. If you're not sure, consider speaking to a financial advisor to get a really clear picture on your financial situation and your investment options. That's it for this segment on understanding accredited and non-accredited investors. By knowing your status, you can make informed decisions and take advantage of the investment opportunities that are right for you. Stay with us as we take a deep dive into different asset classes and explore how you can diversify your investments. Thanks for listening to Do Different Better. I'm your host, Elaine Rasmussen, and I'll see you after the break. Hey there, beautiful people. Welcome back to Do Different Better. I'm your host, Elaine Rasmussen. And in the last segment, we talked about understanding the difference between accredited and non-accredited investors. This determination defines what investments are actually available to you. In this segment, we're going to talk about various asset classes, their opportunities, their limitations, and how you can access them. From stocks to real estate, we'll break it down for you and help you make sure that you make informed investment decisions. So let's dive right in. First, there are 5 major asset classes, and there are some emerging asset classes, and we'll talk about some of those. But some of these alternative asset classes are getting some mainstream traction. So it'll be interesting to see what happens to them over time, if they grow and scale or if they kind of drop off. But today, I'm really going to focus on the big ones. So there are 5. The first one we're going to get into is stocks and equities. So this is one of the most well-known asset classes. Even if you don't know that it's an asset class, you've heard of stocks and you may have heard of equities. Stocks represent ownership within a company. When you buy a stock, you are essentially buying a piece of that company and you are considered a shareholder. But you might ask, like, why would somebody even do that? Part of that is help them to get money to be able to further research, to be able to create their next inventions or their new products that they're going to put on the market. So they're collecting money that's going to sit on their books, on their balance sheet, that they can then leverage or invest either within the company or in other places so that they can get more money to continue to grow the company, right? So that's, and we can talk more about that in another show, but I just wanted to give you a brief overview of like stocks. What are the opportunities? The opportunities, there's a potential for high returns. And one of the biggest attractions of investing in stocks is that you can grow and watch it grow over time. You can see the organization becoming more and more profitable as the stock prices increase significantly over time. And those turn into rewarding the shareholders with capital gains, meaning money. That's all capital gains means. It's money. Additionally, many companies pay dividends, which are regular payments to the shareholders from the company's profits. And usually dividends are paid on an annual basis. You're not going to get a check every month, but you'll get a check at the end of the year. And that check is something that you'll have to pay what are called capital gains tax because you've profited from the investment that you made. And so the IRS always wants their money. So, and that actually gets reported to the IRS from the company when they pay you the dividends. So you'll get a special schedule that says these are the dividends that you received as a result of your ownership in the stock. Owning stocks also give you a say in the company's decisions, as you can vote on corporate matters if you hold enough shares. Now, some companies, if you buy one share, you are able to vote. And those votes are held in a shareholder meeting or through some virtual platform, or as with CenterPoint Energy, some energy companies, they do it by mail, especially when you're voting on the new directors of the board. As a shareholder, you can attend the shareholder meetings, but some companies do have ownership minimums in order to vote in the shareholder meetings. But all of that is typically disclosed to you when you buy the stock, whether you're buying one stock or you're buying 1,000 stock in a particular company. And we'll talk more about shareholder meetings and what happens in a shareholder meeting and why do they hold shareholder meetings. We'll talk about that in another episode, but you might need to remind me. So, what are some of the limitations of investing in stocks? Investing in stocks comes with high volatility and high market risk. You might hear on the news, hey, Apple stock went down like 10 points. That's basically, it might be 10%. It might be actually $10. So you want to listen to some of those clues of like what happened with the stock. But owning stock also, but the stock prices can fluctuate dramatically between due to a lot of different various factors like economic conditions, company performance, or market sentiment. So you may have remembered a few years ago, there was a big blow up in the transgender community against Netflix for some of the programming that they had put on. I think there was also some internal things around how transgender people were treated in the company. That becoming public, and the transgender community and employees and non-transgendered employees who were allies making such a big statement, public statement, and there were news crews, those kinds of things may or may not have a positive or negative impact on the company's stock. It's the company's stock price also is informed by people's confidence in that business. If people's confidence in a business, typically what may happen is the stock price might go down, right? So that's why it's important, where it's not just the operations of the company, but it's also the perception of the company that will highlight or impact the stock price. So these are the reasons why when we talk about the volatility of the market, there's so many things that are in the company's control, but also outside of the company's control that impact the price of their actual stock. But the volatility doesn't necessarily mean it's a bad thing. It could mean that you could have some significant wins in the value of your portfolio. But these are the things you have to be mindful of if you're going to decide to invest in stock. So, who can access stock and where do you access them? This is an opportunity for non-accredited investors. You can access stocks through a brokerage account or online trading. It's become so simple now. When I was 18 and I was a stock analyst, there weren't a lot of platforms where individual people, working class people, could create their own account and manage their own account. Now there's so many online trading companies where you could be sitting in your basement, and there are people who just do that all day. You may have heard the term day trader. That's what they do. They sit in their homes and they are trading stocks all day, and they may or may not necessarily be stock brokers, right? But these trading platforms have made it easier than ever for individuals to buy and sell stocks with just a few clicks. So who regulates these sorts of exchanges? The stock market is regulated by the SEC Commission, or the Securities and Exchange Commission, to protect investors and maintain fair and efficient markets, right? So you might have heard there might be a whistleblower, typically a whistleblower within a company as it relates to anything having to do with the stock prices. They would go to the SEC. You may have heard about when Martha Stewart went to jail for insider trading. A whistleblower went to the SEC and reported what they thought was a misappropriation of information. So here's a fun fact. The New York Stock Exchange is the largest stock exchange by market capitalization, meaning how much information flows. Think of it as the largest airport, not necessarily in size, but amount of traffic that happens. So it is home to some of the biggest companies in the world, including Apple, Microsoft, and Amazon. Investing in stocks can be a great way to build wealth over time, but it's really important to be prepared for the ups and downs of the market. Diversifying your portfolio can help manage the risk. So now let's move on to bonds and fixed income. Bonds are essentially loans that you give to a company or government in exchange for regular interest payments and a return on the principal at the maturity time. Maturity means when the obligation has ended. So that could be a year, it could be 5 years, it could be 20 years, it could be 30 years. That is usually indicated when you purchase the bond. They'll tell you how long the bond is, very similar to a mortgage. What are the opportunities with bonds? Bonds offer steady income, lower risk compared to stocks and capital preservation. They are ideal for conservative investors who seek regular income with less volatility. You'll usually see as you get older in your life, your financial advisor will want to put you in things that are more conservative and more predictable. So they might put more of your money into bonds as opposed to the stock market. There's so many different kinds of bonds. There's corporate bonds, treasury bonds, government bonds, pay for success bonds, savings bonds, municipal bonds, and more. We might just do a show just on talking about the different kinds of bonds because that can be a little bit confusing. But bonds can be sold by your city, your township, a nonprofit can sell a bond, and those are actually getting a lot more traction recently. Nonprofits selling bonds. But we can talk about that more later. So what are the limitations of bonds? The main limitation of bonds is that the lower risk of the lower returns as compared to stock, right? So typically bonds might stay around the 1 to 5% rate of return, meaning if you put $1,000 in, your rate of return might be $100, right? So may not be great if you're 35, is actually really great if you're older because you're really not trying to put your money at risk. You want a steady, slow drip instead of a big windfall. So additionally, bonds are subject to interest rates. Additionally, bonds are subject to interest rate risk. When the interest rates rise, bond prices fall and vice versa. So that is something you want to consider. So who can access these and where can you access them? You can buy bonds through brokerage accounts, bond funds, or directly from the US government through their platform called Treasury Direct. And they're regulated by the SEC as well and the Financial Industry Regulatory Authority, or FINRA. You may have heard that in the news as well, which ensures transparency and protecting investors. So here's a tip. Consider bond laddering to manage your interest rate risk. The strategy involves buying bonds with different maturity or end dates, which then can help provide steady income and reduce the impact of interest rate fluctuations. Bonds are very valuable in a diversified portfolio, providing stability and predictability of income, especially during turbulent markets. So now let's get into real estate. Real estate is one of the most popular and tangible asset classes. Real estate investments can take many forms. They can be residential, commercial, farming land, but also in real estate investment trusts, which are called REITs. We're not going to talk too much about REITs in this episode. We'll get into those a little bit in another episode. But here's some opportunities with real estate. It offers several benefits, including rental income, property appreciation, and there are other tax advantages depending on your state. Real estate can also provide a hedge against inflation as property values and rents typically rise with inflation. But here are some limitations. Real estate requires a significant initial investment. You may need to put down a down payment. If it's a rental income, you may need to make improvements to make the property match the rents that are in that particular area. If you are just buying land, you're going to have to maintain that land. You're going to have to pay the taxes on that every year. And there might be some abatement that you might have to do on that land, or just some upkeep because to make sure you don't incur any fines for maintenance of that land. I know that there are some some cities where if the grass gets too high or the weeds get too high, you can be fined. So you want to be mindful of those kinds of things. So who can access these opportunities? You can invest real estate through direct ownership or the real estate investment trusts or crowdfunding platforms. But REITs allow you to invest in real estate without the hassle of managing a property, as it is a pooled fund for many investors to purpose and manage a portfolio of properties. The regulations of REITs, real estate is regulated by local and state laws, but REITs are overseen by the Security and Exchange Commission. Sorry for if my camera's moving around. We've got our guest here, Mr. Skittle, so maybe he'll decide to make an appearance on the show today. But here's another fun fact about real estate. Approximately 90% of the world's millionaires have been created by investing in real estate. So it's a testament of the potential that real estate can have in building long-term wealth. Real estate can be a rewarding investment, but it's essential to do your homework and understand the dynamics of the market that you're going to be investing in, and also the long-term implications of that particular property. So we're coming to the finish line. There's only a couple of more. So we're going to talk about commodities really quickly. So commodities are physical assets like gold, silver, oil, or agricultural products, meaning lots of people produce it and it's pretty much the same no matter who's making it. Commodities are often used to hedge against inflation and market volatility. So where are the opportunities? Investing in commodities can provide diversification and protection against inflation. The high demand of commodities can lead to substantial returns, especially in times of economic uncertainty. But there's some limitations. Commodities are known for their high volatility and subject to geopolitical risk, meaning what's happening in the politics, what's happening in different geographies. The prices can fluctuate based on global supply and demand, weather conditions, and political events, right? So COVID had a significant impact on different kinds of commodities, right? How do you access these? You can invest in commodities through commodity futures, exchange traded funds or EFTs, ETFs, and through direct purchase. For example, you can buy gold bars. You can buy gold bars from a pawn shop, maybe if they have them, or invest in an ETF that tracks the price of gold. So these are regulated by the Commodity Futures Trading Commission, or CFTC, which oversees the futures and options markets to ensure that they operate properly. Here's a tip. When you use commodities, use a small part of a diversified portfolio to hedge against specific kinds of risk. While they can offer significant returns, the volatility means that they should be balanced with more stable investments. Commodities can add a unique dimension to your investment strategy, providing both opportunities and challenges. And as with any investments, it's crucial to understand the risk, so do your research before committing. All these asset classes are available to accredited and non-accredited investors. The scope and scale of the investment will determine what investor opportunity is available to you. For example, a large 200-unit condo development deal may only be available to an accredited investor, while the duplex down the street is an investment available to both you and an accredited investor. So that's it for this segment on exploring asset classes. By understanding the opportunities and limitations of stocks, bonds, real estate, and commodities, you can make informed decisions and develop a diversified portfolio that aligns with your financial goals. So stay tuned as we continue into the next episode to dive a little bit deeper into some alternative asset classes. Thanks for listening to Do Different Better. I'll see you in the next segment. Hey there, beautiful people. Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen. And in the last segment, we talked about the four major asset classes and the limitations and opportunities of each asset class. In this segment, we're going to dive deeper into alternative asset classes and what are some of the emerging opportunities that will allow you to give a unique edge to your investment portfolio. From the wild world of cryptocurrency to the high stakes game of private equity and hedge funds, we're going to get you covered. So let's go get to it. First, let's talk about cryptocurrency. I know there's a lot of confusion, and I probably will not answer all your questions about cryptocurrency. We probably can have a whole entire show on just cryptocurrency, but my purpose here is just to kind of give you a high level as it relates to investment in asset classes. So this digital or virtual currency uses cryptography for security and operates independently of a bank. So cryptocurrency has nothing to do with our traditional finance system. The most famous cryptocurrency I'm sure you've heard of is Bitcoin, which was created in 2009 by an unnamed person called Satoshi Nakamoto. We don't know if that's a real name or if it's a made up name. We don't even know who this person is to this day. The opportunities with cryptocurrency offer a potential for high returns driven by innovation and the decentralized nature of blockchain technology. They provide a way to transfer money globally without the need for traditional banking system and, quite frankly, the fees that are associated. So every time that you're on Venmo, there are banking fees all the way along that chain. From the time that you send the money to the person receiving the money, there are fees being paid. So cryptocurrency is a way to get around that. It's also a way to get around monitoring. So as you know, you have to your bank account is being monitored, right? As far as the fluctuations. And once your bank account gets to a certain amount, you're only insured for a certain amount. You're only insured for $250,000. So these are all things that cryptocurrency is wanting to move money faster. It is meant to be outside of the traditional finance system, which is a plus or a minus depending on where you're sitting. But some of the limitations, while there is great opportunities in cryptocurrencies, there's Cardano, there's Ethereum, there's many cryptocurrencies that are out there. Cryptocurrencies are known to have extreme volatility. The prices can skyrocket one day and then plummet the next day. There's also regulatory uncertainty and security risks, such as hacking, and the pose for a challenge. This poses a challenge for investors. So you may have heard somebody may have lost their crypto wallet. It's like a gift card. If you lose your crypto wallet, whoever picks it up, more than likely they can't access it, but they might be able to hack into it. But once it's gone, it's gone. You will not. Because there's no plug into the traditional system. There's very little way to get that money back. So if you've got your whole life savings into cryptocurrency and you lose your digital wallet, that money is practically gone, right? So how do you access cryptocurrencies? There are lots of exchanges, and that's what they're called. They're called exchanges of where you can buy all different kinds of cryptocurrency, not just one type of cryptocurrency or Bitcoin. There's Coinbase, there's Binance, there's Kraken. I believe Ethereum also has now developed a platform, an exchange where you can buy and sell and store your digital currencies. Some investors also choose to buy directly and hold their assets in digital wallets, like I was mentioning. So who regulates these? So regulation of cryptocurrency varies by country, and also where so regulation just varies by country. In the US, cryptocurrencies are primarily regulated by the SEC and the CFTC. However, it's crucial to stay updated on the regulatory changes as they can impact the market significantly. So fun fact about Bitcoin, they were the first cryptocurrency, and they once again that we believe that may have been a group of people that put this together, but they're operating under the pseudonym of Satoshi Nakamoto. To this day, Satoshi's true identity remains a mystery. So maybe that will change. It'll be interesting to see. But cryptocurrencies can be an exciting addition to your portfolio, but it's really essential to approach them with caution due to the high volatility of regulatory landscape. Our governments are still trying to figure out how to regulate it, and cryptocurrency keeps wanting to not be part of the system. So they're always working to outsmart the system, so to speak. So now let's explore private equity and venture capital, two investment avenues that offer the chance to be part of early stage companies and high growth businesses. So the opportunities of investing in private equity and venture can yield very high returns. You might hear 30x, 20x, 5x, 10x means you will get back 5 times your investment or 20 times your investment or 10 times your investment. And they provide a thrill of supporting innovative startups. 23andMe was a startup that received private investment from private people. You may have a local business that has done a crowd raise to get investments from community. But you can get involved in the growth journey of these companies from the ground up, which can be incredibly rewarding. Opportunities investing in private equity and venture capital can really yield a lot of high returns, but there are limitations. These investments come with high risk and illiquidity, which means you can't get your money out quickly. That's what, when somebody says this investment is liquid, that means you can get your money out relatively easy. And when I say easy, I mean usually within the 30 to 60 days. If it's illiquid, you're talking about maybe it could be a year, it could be 2 years, or there might be what's called a period where you have to keep your money in. There's a minimum amount of time that you have to keep your money in. They typically require large capital commitments and they're not easily sold or exchanged for cash. This means you need to be prepared for a long-term investment horizon. A lot of times it's a minimum of 7 years minimum. And usually sometimes they'll ask you for an extension, which means it'll go to 10 years. So you just want to be mindful of can you withstand that time horizon based on the amount that you've invested? So accessing private equity and venture capital is usually limited to accredited investors, as these investments are often made through private equity funds or venture capital firms. They go out and collect the capital, and then they make investments into different kinds of businesses. So you're not necessarily investing directly in the business if you're going through a private equity firm, but you certainly can do your own investment, but then you are responsible for doing that due diligence process, which we talked about in another episode. So go back to that episode and learn more about the due diligence process, and you'll understand like what is doing the due diligence yourself versus investing in a private equity company that will do the due diligence for you, who have the expertise. So here's a tip. Oh, before I talk about the tip, let me talk about, they are regulated. Private equity and venture capital is regulated also by the Security Exchange Commission. And this is once again to ensure protection for investors, but transparency in the market. So here's a tip. Excuse me. These investments are typically long-term and should align your risk tolerance and your investment horizon. If you're interested in private equity or venture capital, consider your financial goals and how much risk you're willing to take. While they can offer significant returns, you definitely have to be in for the long haul. Again, these opportunities are usually only available to accredited investors. And so if whoever you're talking to about the investment opportunity will usually ask you upfront if you're an accredited investor, but you'll also need to certify that in any documentation. If they want to send you the deck, they might send you some kind of form or letter saying that you are certifying that you are self-identifying as an accredited investor. Now let's dive into hedge funds. Yay! Hedge funds are pooled investment funds that use diverse strategies to generate returns, often employing techniques like short selling or leveraging. So when we talk about, I'm going to totally talk about this quickly because that's another whole show. When you are short selling, meaning that you're predicting that something bad is going to happen or that there's going to be a downturn in the either stock price or, if somebody was looking at, November of 2019 and was seeing that there was a trend of people getting really, really sick, they may have over leveraged buying into companies that are related to healthcare, or they may have shorted those other things that have. When I say that they shorted, that means they made investments that said that there would be a market failure, or in certain industries in relation to dealing with this thing that then became COVID, right? So that's how that works. But once again, we'll do a whole nother show on shorting, short selling, and leveraging. But getting back to hedge funds have, the potential for high returns through their diverse strategies. But their aim is to deliver positive results, regardless of whether the market is up or whether the market's down, right? They're making bets that things are or are not going to work out. The limitation is that hedge funds come with high fees and high risk and limited transparency. The management and performance fees can be very substantial and very complex strategies that they are using to make it hard to understand what's happening with your money. So, once again, hedge funds, you really want to have some sense of understanding of how they work. But as far as accessing hedge funds, it's generally limited to accredited investors through hedge fund firms. This is an exclusivity that is due to the high risk nature of these investments. And they are also managed or regulated by the SEC, once again, to protect investors, but also maintain market integrity. Here's a fun fact. Hedge funds can employ different strategies like short selling to leverage and generate returns in various kinds of markets. This flexibility is one of the reasons that they can achieve high returns, but it also adds to their complexity and risk. So hedge funds are a powerful tool in your investment portfolio, but they require that you have really a lot of good information and a willingness to pay for the expertise of the hedge fund. So as we start to kind of land the plane here, now that we've explored the different kinds of alternative assets, we really now I want to really get into some of the tips and a call to action. So first, take stock of your current assets. Understand what you own, understand what you owe, and understand what your financial goals are. Use financial tools and apps to track and manage your investments. Some people get a little obsessed about it, but you might want to mark maybe 15 minutes in your day. Maybe it's with your morning coffee, or maybe it's on Sunday morning to just kind of see, where am I at? What happened this week in the market, right? But you want to be mindful that to get too obsessed, it can take over your life. Remember, there are people who do this as a job for a living, and unless you want to do that, you don't want this to take over your life. But you do want to have some sense of awareness, and to have a clear picture of your financial health so you can make informed decisions. So here's my call to action to you. I challenge you to identify and research one new asset class that you're currently invested in, whether it's private equity, whether it's real estate, maybe it's your 401k. Take the time to learn about it and consider how it might fit into your portfolio, or how maybe look at a new asset class and figure out how you might want to leverage that into your current portfolio. So here's some tips for some new investors. Start making small investments and gradually diversify. Educate yourself through books or listening to Do Different Better and financial news, because the more you know, the better equipped you're going to be to make smart investment decisions. And don't hesitate to seek advice from experts like financial advisors. They can provide valuable insights and help you tailor your strategy to help you with your specific goals and your risk tolerance. So diversifying your asset classes is the key to building a resilient and profitable investment portfolio. So stay tuned as we continue to go and talk more about the investing journey in future episodes, but also keep learning and adapting as you go. It's an amazing, amazing trip to go down. It's an amazing journey. I'm just telling you from my own personal experience, it's been fun. It can be anxiety producing. And so I think going back to the episode where we talk about the mindset money, I just was listening to a show last night and it talked about the relationship you have with money is it mirrors a relationship you have with yourself. So if you feel like you have an unhealthy relationship with money, unpacking this might be a journey for you to have a healthier relationship with yourself. When you attack the thing that is probably maybe scary for you, it opens up all these windows and doors to demystify and come from a position of strength and a position of worth. So, well, we are wrapping up another episode of Do Different Better. I'm your host, Elaine Rasmussen. We explored the world of investment classes. We learned about the different types of investment classes, which are the categories of the investment instruments where you can invest your money. We discussed the opportunities and limitations of each asset class, how to access them, and the regulations governing them. We learned the difference between accredited and non-accredited investors. So join me in the next episode of Do Different Better with Elaine Rasmussen, and we're going to dive into the world of debt in wealth building and the difference between good and bad debt. I cannot wait for next week's conversation where I show you how to do Different, Better. Let me know what you think of the show. We'd love comments. So tell us how this show helped you. If you have a money question or a finance question, if there's somebody you want me to interview, hit me up on LinkedIn or Instagram. Don't forget to hit the subscribe button and follow us on our socials. Goodbye for now.